All right, guys. So in this video, we're taking a look at JEPI or SPY. Which one would be the better pick and why? So first of all, I want to say this, and I think it really comes down to your individual goals and what you're trying to accomplish. And it really comes down to like if you're a cash flow investor or if you're just more of a growth investor. And you can be both. Like that's why there's dividend growth investing. And that's why I love about cash flow investing is you can spread out your assets to multiple places and kind of have a good mix going on when it comes to your cash flow portfolios. Excuse me. But that is an important consideration here. And I don't think it can go unaddressed with an ETF like the JP Morgan equity premium income ETF. It's a great portfolio if you want to buy for cash flow, and we can look at the dividends, but we can also look at some contrary opinions, and I'll leave this article below. Now, you do have to pay for Seeking Alpha, so they do give you some free articles, though, a lot of times if you want to check this out. But this article here, offering a 10.6% dividend yield and downside protection in a bear market. But the important consideration and what this article brings up, which I think is important, is that there's no free lunch. And so the benefits do come with a drawback. And so if you're an investor in JEPI or Jepi, however you want to pronounce it, it's likely to underperform significantly in the next bull market is what this article basically goes into. Having said that, though, ask yourself what your goals are and what you're trying to accomplish. Because if you are looking at cash flow from a comprehensive perspective, you can definitely get different types of cash flow going. You don't have to just sit there in one asset class, in one specific investment. Now, it really comes down to how diversified you want to be. For me personally, I would like to start building more of a blue chip dividend portfolio with covered calls, the wheel strategy kind of incorporated in that, and getting that going along with dividends. That would be my long-term goal. But ask yourself what your long-term goal would be. And ask yourself, would you want to buy an ETF like this, which, going into this here, you'll see the SPY chart here on the top and then JEPI on the bottom. And you can see how over the long run, you're going to get a much bigger move. The S&P 500 from going back to the lows in March 2020. Now, this ETF actually came out and it looks like May of 2020. Having said that, it was after the crash, but you can kind of look at the perspective of where was it trading at in May? The S&P 500 was down all the way to 287, and so the S&P 500 has far outperformed JEPI over that time frame. So although you will get some capital appreciation, that is what I like about this ETF. In a bear market, like for example, you'll see right now it's interesting that the JEPI is actually down more than the SPY. I wonder why that is. But typically you're going to see the S&P 500, if this performs the way it should, JEPI will go down less than that the SPY. And I'll have to check the pricing on that. But typically you'll see the JP Morgan Equity Premium Income ETF go down less than the S&P 500. That's how they want it to be set up anyway. But you'll see lately this one has been going down all the way from $63, now down to $52, and we're down. The low is $49.50 right after it went public in 2020. So we really don't have a long track record of JEPI, and I think that's an important consideration if you're an investor in this ETF. But having said that, if you're looking at this from a long-term cash flow perspective, you do have to keep in mind that the market is down and it is at a discount. And so ask yourself, how do you see this performing if you're going to buy this, let's say for the first time, or let's say if you maybe bought at some higher prices and you're trying to average down. Ask yourself, are you concerned with capital appreciation? Do you believe you will get some of that investment back? Because it will go back up once the market starts recovering. That's how it should perform. But having said that, are you comfortable taking the risk that this does see a significant drop? Because like I said, that is a consideration. This ETF has not been around for a super long time, so you just have to look at that from that kind of perspective. But as I mentioned in my other video, talking about QQQX, I made a video yesterday. You can check out that video, link in the description. But I wanted to kind of bring up just the fact that these ETFs are not designed for significant capital appreciation. And you can look at an ETF, if we replace the SPY with QQQX here, you'll see that this ETF here has not done, this is actually a closed-ended fund that has not really done much over the last several years. It did go down to 15 and hit 31, so it actually did not do bad. That's on a short-term basis, though. I want to pull up a long-term chart, and you'll see exactly what I mean for an ETF like QQQX. So as I mentioned in my last video, you'll see that over the long term, like since 2007, this ETF started at $20, and now we're trading at $20.76. And so the question becomes, will this fund recover or go past the all-time high of $30 ever again. I mean, I'm sure the market over the long run will recover, but what happens to an ETF like this if you're just focused on cash flow? We really haven't done much over the last several years, and so that's a very important consideration. I think, just looking at not really the long-term horizon for JEPI is a consideration, but also just the fact that these funds are not designed for capital appreciation specifically. And you will get some of that, I think, with the JP Morgan ETF, but nonetheless, it really comes down to your individual goals. And this is something I've talked about, like when you're looking at what to add to your portfolio. If you want to do a 5 to 10% allocation to these types of exchange traded funds, that's definitely something you could do. And that's the beauty of cash flow investing, is that you can have kind of that diversified portfolio if you want to. You can have the cash secured puts, you can have the wheel strategy, you can have the covered calls and the dividend stocks, but you can also have more of just a comprehensive approach, I think. And that's the beauty if you want to start getting those dividends and you want to start adding significant streams of income to your portfolio. And that's what I love about cash flow investing. But looking at an ETF though like this, you can see that the last dividend was 0.559. And so we can kind of run the numbers here on how much you would get. And so if you do the math on a $100,000 investment at, let's say, where it's trading at $52 right now, you'll see that you can buy 1,923 shares. And with the current dividend, 0.559, or that was actually an error. Let me try that again. So 0.559, or we could just try that. About $1,000. It was actually $1,075 to be exact. But $1,071 is what you're looking at in terms of that dividend. So it's pretty cool to think about. And obviously this dividend is going to be variable. And so you also have to consider that if you're an investor. But nonetheless, I mean, you'll see that some months you're going to be getting like 38 cents. Another month here you have 55 cents. You have 62 cents. And so ask yourself, like, if you just wanted to consider the cash flow received from an investment like this, would it be worth it? And would you want to invest in something like this? I think that's a very important consideration regardless of the type of investor you are. Because if you're just going to put all your money into covered call ETFs and do nothing, ask yourself, what is the benefit of that over the long run if you're not going to see capital appreciation? Or are you just interested in perhaps retaining your maturity? Well, do you expect those funds to keep going down or recover? And how long would that take with these covered call ETFs in a bear market, for example? So nonetheless, if you're looking at these investments and you're looking at covered calls and cash secured puts in particular, you can actually do this against blue chip dividend stocks. And I actually have a new channel that I'm working on in terms of like a private membership site on this channel that's already existing. So it's going to be part of the channel, but it'll be like a paid membership thing for $4.99 a month, where I go into a lot more detail with options. I've actually been working on a lot of that content, so you can check that out if you're interested. Once I reach 1,000 subscribers and get monetized, I'll be able to go ahead and do that. And I just want to say I really appreciate the support on the channel. I know that we've been doing this here for a couple months now, and I haven't made videos super consistently, but you guys have been awesome with the support and the comments and all that. So thank you so much for that. And with that being said, check out that membership site. When it's live, you'll see it down below. Check out the links in the description if you want to learn more about the ETF I just talked about, JEPI, the JP Morgan Equity Premium Income ETF once again. And I guess we could go over this real quick as well. So you'll see that this is designed to provide current income while maintaining prospects for capital appreciation. So kind of like we were talking about, I think this ETF does have the potential in terms of being better than a lot of other covered call ETFs like QYLD, RYLD, and all those kind of ETFs over the long run. But this is basically going over the approach. Generates income through a combination of selling options and investing in U.S. large cap stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends. Constructs a diversified, low volatility equity portfolio through a proprietary research process designed to identify over and undervalued stocks with attractive risk/return characteristics. And then finally, they also seek to deliver a significant portion of the returns associated with the S&P 500 index with less volatility in addition to monthly income. So if I was an investor, this would be the main thing I would consider, because the dividends are great, but it's going to be 7 to 12%. How much of that is capital appreciation? And that'll be interesting to see, I think, over the long run. So with that being said, guys, you'll see down here the gross expense ratio, the net expense ratio, 0.35%. They have the value of the investments under assets. And I'll leave this link down below if you want to check it out as well. So you'll have all those links to check out if you want to do more research on this exchange traded fund. But as always, do your own research, get some more due diligence on it, talk with your financial advisor if you're working with one. And with that being said, guys, I hope you enjoyed this video. And until next time, I will see you guys in the next one, and take care.